Welcome to Money and Markets Series 5, Lesson 2. In the last lesson, we explored liquidity, the invisible force that separates a healthy market from a frozen one. This lesson goes one level deeper, into the infrastructure where liquidity is created. Exchanges, the venues, the rules, the matching engines, and the participants who make prices possible. By the end, you will know exactly what happens between the moment you click buy and the moment your trade settles. Before stock exchanges existed, traders met in coffee houses. In 17th-century Amsterdam, merchants gathered near the harbor. They would buy and sell shares of the Dutch East India Company, scraps of paper that entitled them to a slice of the profits from voyages to Asia. There were no screens, no algorithms, no circuit breakers, just buyers, sellers, and someone keeping score. Today, nearly all of that trading has moved to electronic matching engines that process millions of orders per second. But the underlying logic is the same. An exchange is just a place with rules, where buyers and sellers can find each other. This lesson goes inside those rules. How orders work, how they match, and who profits from standing between you and the market. An exchange is a regulated marketplace with three jobs. First, price discovery. By bringing buyers and sellers together, the exchange produces a price that reflects the current best estimate of an asset's value. That price gets broadcast to the world. Second, liquidity. Because everyone goes to the same place, you are far more likely to find a counterparty than if you were searching on your own. Third, transparency. Exchange rules require public reporting of prices and volumes. You can see what trades are happening in real time. The two largest stock exchanges in the world are the New York Stock Exchange and NASDAQ. Between them, they handle trillions of dollars of trading every single day. Exchanges are not the only place to trade. Some trading happens directly between two parties over the counter. But exchanges remain the backbone of modern capital markets. When you want to trade, you have a choice of how to express it. A market order says buy or sell right now at whatever price is available. It guarantees execution. It does not guarantee the price. A limit order says buy this, but only if the price reaches X or lower. Sell this, but only if the price reaches Y or higher. It guarantees the price. It does not guarantee execution. Most retail investors use market orders because they want to trade now, and the amounts are small enough that price impact does not matter. Institutions often use limit orders to control their average purchase price, especially when moving large positions over hours or days. The interplay between these two order types is what creates the order book, the live record of every intention to buy or sell, waiting to be matched. Imagine a public ledger with two columns. On the left, all the buyers, ranked from highest to lowest willingness to pay. On the right, all the sellers, ranked from lowest to highest asking price. The best bid, the highest price any buyer will pay right now, sits at the top of the left column. The best ask, the lowest price any seller will accept, sits at the top of the right column. The gap between them is the spread. When a new market order arrives to buy, it immediately matches with the best ask. That trade executes. The next buyer matches with the next cheapest seller. This book is live. It updates thousands of times per second in an active market. Every new order, every cancellation, every trade changes the book. When two limit orders are at the same price, which one gets filled first? The answer is almost always the one that arrived first. This is called price-time priority. Price first, then time. It is how most major exchanges run their matching engines. The engine constantly scans the book. The moment a new order crosses an existing one, meaning a buyer is willing to pay at least what a seller is asking, the engine executes the trade instantly and automatically. The matching engine at the New York Stock Exchange processes over 1 billion messages per day. Each message takes microseconds to handle. This speed has created an arms race. Some trading firms pay millions of dollars to co-locate their servers inside exchange data centers, shaving nanoseconds off their order delivery time. Not every trade matches a natural buyer with a natural seller. Sometimes a buyer needs to trade right now, and no seller is waiting. That is where market makers come in. A market maker continuously quotes both a bid and an ask. They will buy from you if you want to sell and sell to you if you want to buy. In exchange for this service, they earn the spread. If the spread is 3 cents, the market maker buys at $12.48 and immediately looks to sell at $12.51. That 3 cents, over millions of trades per day, is the business. Market makers assume inventory risk. If they buy a stock and the price falls before they can sell, they lose. The spread is their compensation for standing ready, regardless of what the market does next. Not all trading happens in the light. Dark pools are private trading venues where orders are not publicly displayed. You submit a large order and it sits invisibly, waiting to match with another large order at a price derived from the public market. Why would anyone prefer the dark? For a large institution moving $100 million, showing that order publicly would be costly. Every participant watching the order book would trade against it, pushing the price higher before the institution finishes buying. Dark pools solve this by hiding the order until the trade executes. The downside is reduced transparency. Critics argue that too much dark pool activity undermines public price discovery. Regulators in the US and Europe have placed limits on how much trading can happen in the dark. In 2011, a company built a fiber-optic cable from Chicago to New Jersey in a nearly straight line through mountains and farmland. Cost: $300 million. Purpose: shave 1.4 milliseconds off the time it took to send an order between the Chicago and New York exchanges. This is high-frequency trading. Strategies that rely on speed, not insight, to trade profitably. HFT firms make money by being faster than everyone else. They see a price update in one market and immediately exploit any gap in another before a slower trader can react. Whether HFT benefits or harms ordinary investors is genuinely debated. Most evidence suggests it narrows spreads and improves liquidity in normal conditions, but amplifies volatility during crashes. An exchange is a regulated marketplace. It brings buyers and sellers together, produces prices the world can trust, and requires transparency. Market orders trade now at whatever price is available. Limit orders wait for a target price. The order book is the live queue of all waiting orders. The matching engine connects them by price first, then time. Market makers earn the spread for always standing ready to trade. Dark pools hide large orders to reduce price impact. High-frequency traders race for nanoseconds. Understanding these mechanics is not just academic. It explains why your brokerage route matters, why large trades require strategy, and why the price you see is not always the price you get. In the next lesson, we look at the financial invention that put all of this inside a single tradable share: the exchange-traded fund.